Hi, my name is Reed Silverne. The name of this show is Fed Pride. The reason it's called Fed Pride is because I'm a federal worker, retired, and proud of it. Today, for me, it's November 28th. For you, it's probably November 30th, Sunday, or I believe December 2nd, Tuesday. For me, it's, of course, a Friday. And what Friday is it? It's the Friday after Thanksgiving. I, too, was surprised that Access was open. I'm glad it is. The people who run Access set up my shot, but I am the engineer. I have an anchor desk over here with a computer behind me and blue screen, and I'm able to access the computer. If you notice that my t-shirt over here is blue, so it's transparent to whatever's behind me, and I can try to minimize that. So what is occurring today? What's occurring today is very, very interesting, and it is what we call Black Friday for retail. Now, it sounds like Black Tuesday. Black Tuesday was the day the stocks collapsed in the beginning of the Great Depression, and people stampeded around the trading floors. There was yelling and screaming and total chaos. And eventually people lost everything and jumped out of windows. Black Friday is a similar situation, except that people are rampaging around stores looking for bargains. Already, we've had a situation where there was a stampede, and I'm going to show where this is over here. Right over here, I'm going to put it on the other side of me. This, of course, is the New York area. That's Long Island. And in Queens, New York, there was a terrible stampede at a Walmart. The Walmart had promoted a very, very big Black Friday, day after Thanksgiving sale, and hundreds of people lined up and obviously couldn't wait because they tore the doors off of the store. They literally tore them off the store, stampeded into the store, knocked over a clerk who was then trampled to death. They also knocked over a pregnant woman who had a miscarriage and lost her baby. Just kind of shows a combination of our present situation, which is teetering on the edge of a super recession, not even a regular recession, and at the same time encountering bargains. So people basically went mad at that particular Walmart with two casualties instead of just one, and a horrible, horrible situation. On the other side of the country, over here in California, there was a shooting at a Toys R Us. A guy went berserk and killed two people at a Toys R Us, and that is what has occurred just as part of the Black Friday, day after Thanksgiving festivities, so to speak, when all the really, really big beginning of the holiday season sales and the official beginning of the Christmas shopping season. Because I've been talking a lot about the economy, what is the importance of this? Well, just to check things out, and also because I needed to buy some gifts. My family went out to the mall. We went to the Tucson Mall right here, and it was packed. I have to admit, the parking lot of the Tucson Mall was filled to the brim all the way to Wetmore, to the absolute end of the street. In the last 10 or 15 visits to the mall, I have never seen it so hard to find a parking spot over at the Tucson Mall. Apparently, every single spot was filled, and you had to drive around back and forth looking for a spot for somebody to leave, basically. So I don't know about the back side of the mall, the food court side, but the Red Robin side of the mall was filled to the brim all the way to the street in two directions. So that should be good news. Question is, are people spending? And I can definitely attest that there were lots and lots of people at our mall this particular Black Friday shopping day. And just as a funny little check, I went through the, I had to go down a row through the mall parking lot, and I personally passed at least 11 or 12 SUVs, a lot of new cars, all with Sonora license plates. And before everybody goes and starts jumping on me about illegal aliens and all that, people should realize that at least here in Tucson, we do have a linked economy with the middle class people in Mexico. And they love to come. I don't know whether there's special ads or what, or whether they advertise on Mexican TV over the border. But there's a tremendous influx this time of the year of Sonoran license plates. How do they get across the border? Well, contrary to popular opinion, we actually do have and do give out day passes to go to the United States and shop. We do have a united economy at the border. Especially, I believe all you have to do is just show a pass to get to Nogales. But I believe that there's a zone, I'm not sure, but it could be 60, it could be 100 kilometers or 100 miles, I'm not sure which. But Tucson is within it, where Mexican people who want to come to the United States and shop and see what's going on at the border are allowed to come across the border. They have to show their ID, and they get a day pass, basically, which is like a visa to visit the United States. There's nothing wrong with that. And in this case, it seems to be really filling the mall and keeping a lot of Americans employed over at our mall. And there's no doubt about it. If you want to work at the mall, it's a good idea to be bilingual. Because a lot of, at least at the Tucson Mall, customers are Mexicans from Mexico with Sonoran license plates, sometimes Chihuahua. I also saw Texan license plates, Colorado, and of course snowbirds from the East Coast. So a lot of people are over here. A lot of people are buying. I hope they're buying. I hope they're not just looky-looing. I myself bought about $100 worth of gifts and presents, and a good time was had by all, at least by me. So if this is true, and if this ends up being true, and we have something close to a normal shopping Christmas season, it may mean that the recession is not as bad as it's tacked up to be. It also might be that those people that are still employed might want to have one last good Christmas before they're out of money. So let's hope that this occurs. Let's hope that people buy, because in America, 2/3 of our economy, domestic economy, 2/3 of our GDP, gross domestic product, is all consumer spending. And this week, there was a big step forward to trying to guarantee that consumer spending would continue. All because, again, I've been talking about the dreadful result of the derivatives fraud. There was another kind of derivative that I talked about a little bit in the last couple of weeks, and that is what they call, instead of pass-through, where the interest from various pools of mortgages and so on and so forth would pass through to the buyer of the derivative, and the derivative didn't own any of the underlying asset. Well, they did a very similar thing with credit card debt. So whatever previous mechanism for selling credit card debt from one company to another has disappeared and has been replaced with what they call pay-through revolving credit derivatives. So these are derivatives that are bought as fixed income bonds against something that's completely not fixed income, which is credit card debt. At any time, if you have a pool of credit card debt, there's a 10,000 credit cards being people borrowing against it, paying off some of the principal, increasing their balance, decreasing their balance, all going into a pool. They call it a revolving pool because they never know exactly how much is in it. And why anybody would buy a derivative based on this is questionable. So again, these are packaged up with swaps so that if the default rates go above normal, or what they considered normal, which was way below the historical norms again, they could cash in swaps. Now, as I've described before, swaps are side bets. They're like buying insurance on your blackjack table. If you buy insurance on your blackjack table, and the amount that you pay is 1/100th of the weighted value of the chance that the guy in front of you is going to get blackjack. The people who give those side bets are not going to pay off. And that's basically what happened with credit swaps. And so even if the default rate would go up, the derivative would become even more worthless because the credit swap did not raise enough money, did not have enough capital to pay off if the default rate went to the point where the credit swap was issued. What if it went over? Well, again, even in these revolving pool credit card derivatives, they basically misread the whole thing. They set the default rates and the credit swaps at rates that had been achieved during historical recessions in the recent past. So they're worthless. And because that market froze up, if you get a credit card and you maintain a credit card balance, there is really no mechanism for that credit card company to sell it to another one. And also day-to-day finance, commercial paper has already frozen up, and the commercial paper was guaranteed by the Federal Reserve. Now, this last week, between the Secretary of the Treasury and the Federal Reserve, they are now going to guarantee the derivatives based on credit cards, so that going into this season, this Christmas season, people will still have credit to be able to at least keep their lines going on their credit cards. Is that going to increase the amount that's spent at Christmas? Probably not, because a lot of people are worried. A lot of people are paying off their credit cards, and by definition, paying off early. That's why a lot of credit card companies have a weird deal where if you pay it off, there's a penalty. There's not a penalty for, there's also a penalty for paying late, in which case your credit goes, or at least your interest rate goes skyrocketing. They also charge you to pay off early because they've sold derivatives based on these pools of revolving debt, based on your keeping your balance. And if you don't keep your balance and you pay off your credit cards, basically there's no interest coming in. And if somebody issues a bond against it, it's ridiculous. It's not, you cannot create a bond against credit card debt because some people are paying it off, some people are extending, and during recessions, people have a tendency who have the money to pay off more, which is actually a minus to anybody holding a bond based on credit card debt. So the whole idea was ridiculous. The market should never have been allowed to be created, and now they're supporting the market in credit card debt revolving derivatives. And that's called pay-through and not pass-through. Pass-through means that there is interest that's being paid. It's being paid on a set specific program. In other words, if you have a mortgage, you owe a certain amount of interest and a certain amount of principal you pay in your mortgage payment. So that can be known. With these pay-through, basically what they're doing is they're yielding cash out of that pool of credit card debt and then paying the holder of the derivative their interest as if they were holding a bond. What's the problem with that? A, it's ridiculous. B, the companies that issue the derivatives probably have created a partnership that owns the pool and that pays through. Thirdly, the third problem is anybody who's foolish enough to buy such a derivative doesn't own anything. All he owns is a claim on the pay through from the pool of credit card debt. He doesn't own the credit card balances. He doesn't own anything. He is completely out to lunch, and when that thing goes worthless, it goes completely, totally worthless. So who's been buying these? Banks, retirements, so on and so forth. It's all part of the same scam that started with subprime mortgages and then regular mortgages and then commercial paper and everything else. And it's needing to be bailed out by the Federal Reserve, who's making money created out of air, basically, which is how the Federal Reserve works, in order to liquefy the economy so that people can still keep using their credit card during this Christmas season. Is it good that they're able to use their credit card? Yes, because if they didn't, they might not be able to buy food by the end of the month, especially if they've just been laid off. Is it good for the retailers? Yes, some of them will stay in business because of this move, and perhaps. But what they really should do, and I'm very, very convinced of it, they need to create a new market to replace derivatives, and they need to make a market in order to buy and sell blocks of credit card debt that is completely separated from derivatives, in which the buyer actually owns the debt itself. A debt, which means that all these people have credit cards, they owe money and balances on the credit card. That's considered an asset to the lender, and people should be able to buy the asset, not just a claim of the cash flow from the asset. It was a quirk in the tax law that allowed these issues of the derivatives to pay through instead of actually selling the credit card debt. If they sold the credit card debt, then they would be considered, it would be considered a true sale, and they would owe taxes on the true sale if the value had gone up. So in order to get around that, they've created this really terrible situation where the entire system, not just credit card debt, but car loans, student loans, mortgages, all different kinds of debt, muni bonds, you name it, that have been perverted by the creation of these derivatives. And the only way to do it is to create new markets or resale of these assets so that we can go back to a situation when our economy was healthy back in the 1970s or 60s and 50s and 70s, where there was a secondary market after the loans were made. And we need to dump the whole concept of pass-through or pay-through derivatives that is screwed up our economy. The people that got rated and asked for ratings for these were frauds. Basically, the potential for these being rendered worthless was very, very high from the beginning and was covered up by the people that got rated. Basically, the raters did not understand what they were rating. So the ultimate result was that we don't have a secondary market in car loans. Somebody issues you a car loan, they're going to have to service that car loan until you either pay it off or trade in your car and then pay it off that way. So, and same thing with credit card debt, same thing with student loans, and that is not the way to create a liquefied market so that people can do business and give loans and give credit and let other companies who are, have repo men and have credit servicing organizations together to be able to buy these mortgages, car loans, whatever, and service them until they're paid off at a profit. So somebody's got to be able to do that. We've destroyed that system up to now, and we need to recover the way we were doing it before, because we've destroyed markets that had a purpose and had a reason, and let them be replaced with derivative fraud. And that is a bad thing. Meanwhile, we have rescued credit cards for good or ill, and hopefully we will have a decent shopping season. I kind of think that it won't be as good as last year, it won't be as good as previous years, but it'll be better than a shopping disaster or an economic disaster that they're thinking of, because people want to give their family a good Christmas while they're still employed. People are afraid. People are afraid to spend. People are afraid that they're going to be laid off. There are layoffs coming, tremendous layoffs, and tremendous unemployment. But most of that has not hit yet. A lot of people want to save their money, but a lot of people want to give their family one last good Christmas before and if economic disaster strikes. So I'm kind of optimistic in a pessimistic kind of way that we'll have a decent Christmas spending year. It won't be as good as previous years. People just don't have the money. They probably still have credit cards, and the credit cards still probably work, mostly because of this activity by the Treasury Department, the Federal Reserve last week. Took them that long to realize that this crisis was going to expand to credit card debt, to save the credit card industry and to save the retail industry, and thank God for that. Now, this is the second saving of the retail industry, because 2.5 months ago in September, the commercial paper market completely seized up. Nobody could buy it or sell it. Why? Because they had issued derivatives against commercial paper. Commercial paper are short-term loans that are put out by companies to handle their inventory on a very, very short-term basis. So Walmart buys $1 million worth of food and Christmas ornaments and so on and so forth, and then they're sold at a very, very tight margin, and then they take their 1 or 2% margin and they pay off their commercial paper from the last week or the last month. Then they buy commercial paper to finance their next week or month of inventory. That's what keeps the system going. And that had seized up a couple months ago. So we would have had, instead of just Mervyn's and a couple other smaller chains going under, nobody could have done business. That's how close we were to an ultimate collapse of our financial system, especially in September and October. Hopefully, we'll keep it going. I'm hoping we also bail out the car industry. The car industry is beset by basically the collapse of the secondary market in car loans. And I've talked about that on the show too. So I'm hoping that we at least keep it going until we can get the car loan industry going again. And the best way to do that is not to buy out or to have a new, better derivative system, but to actually create a secondary market in car loans, so that if a car dealership gives you a car loan, they can sell it to somebody who has repo guys and who knows what else to be able to service that loan. So I'm hoping for a good Christmas, and I hope everybody else is, because our economy really needs it. My name is Reed Silverne. The name of this show is Fed Pride. The reason it's called Fed Pride is because I'm a federal worker, retired, and proud of it. Thanks for watching on Sunday or Tuesday.